Today I'm going to share some of my observations. I don't know if I necessarily have very firm answers in terms of where we are going for the economy and how it flows through and affects us in agriculture and in particular the swine industry. But I want to share some of these observations that I did while I was employed at the Federal Reserve Bank of Kansas City. Some of the things that we followed in the trend. What we did there was to look at the macro economy as well as the global economy and to try to make sense of that and how it flows through and affects us here in agriculture. So with that today, to frame a lot of my talk, I'd like to focus on a fairly broad question and bring in some insights from that, is to look at how will agriculture and the swine industry in particular fare in today's economic climate. We certainly are coming through a very turbulent period when we saw a financial crisis and recession really shake the U.S. to its core as well as the global economy. Now through that, one industry that did fare fairly well was agriculture. We saw agriculture post some gains through that time, which helped to boost up rural economies. But one industry within ag did suffer a little bit with curtailing demand, and that was the livestock industry. We did see profits come back, or profits fall for livestock producers. But here, as we've entered into a mode of recovery, we've seen some of those profits bounce back. Now, there are certainly many questions out there that is surrounding not only the U.S. economy, but also the global economy. From when will this elevated unemployment rate come down, to how will the eurozone sovereign debt crisis flow through and affect us in agriculture. Some of my observations will be on those points there to kind of talk about some of the opportunities and associated challenges that are facing agriculture today. And that's how I'm going to address this question of how will ag fare in today's economic climate, to look at a set of 10 opportunities and associated challenges. The first opportunity to point out is we are in a mode of recovery. The U.S. is recovering from a very steep recession, although it is a very slow or anemic recovery, which presents a number of challenges for us today. If we look at one way that economists like to gauge the economic health of an economy is to look at gross domestic product, or the value of goods and services that are produced within a country. And if you look at the U.S. GDP growth, you can see how severe the financial crisis and recession was. On an annualized basis, we saw Q4 in 2008 GDP growth of negative 9%. Now, to put this into perspective, how severe that was, that set us back about 3 years to 2005 GDP levels. Now, since that time, we've come out and we've begun to see a mode of recovery. And a lot of that robust growth occurred in 2009, 2010. But that was from inventory restocking. Manufacturers and businesses through the financial crisis really pulled back and worked off a great deal of their inventory. But at some point in time, they did have to restock shelves, so to speak. We saw a big inventory buildup, which helped boost GDP. But since that time, here especially in 2011, that growth has been very slow. And recent soft data has revised that down significantly. In fact, in 2001, the annualized growth in Q1 is about 0.4%, and Q2 is less than 1%. From initial jobless claims that continue to rise, out of work employees, too much debt setting on businesses and household balance sheets are all weighing on the economic recovery. And in fact, if we look at forecasters, as economists are, we had a forecast in July from the data that we had at hand, which was right at about 3%. But just that soft data that came in August, we saw those estimates revised down to about just at 2%. So going forward, there's a lot of questions about whether or not this economic recovery is sustainable or not. But the key for any recovery, especially in the United States, is consumption. We are a nation of consumers. Roughly 70% of our gross domestic product, or GDP, comes from consumption. So as the consumer goes, so does the rest of the nation. In fact, what I've plotted up here is personal consumption expenditures throughout time. And one thing that pops out right away is that when you see the consumer pull back or their personal consumption drops, you enter into a period of recession, as indicated by gray bars on this graph. But most recently, it was extremely severe, the financial crisis, where we actually saw consumption dip into negative territory on a year-over-year basis. And a lot of that was just driven by consumers deleveraging, having to work off an excess amount of debt and return back to that amount of savings. Now, for the recovery to take hold and to move forward, we need to see that consumption rebound. But the question that I have is, currently we're at a consumption on a year-over-year basis of about 4%. Should we consume like it was 1999, when we had consumption nearing double-digit errors, or double-digit numbers? Now, some research out of the San Francisco Federal Reserve has pointed to possibly that's not the best path for long-run stable growth. The research points to the fact that we need to return more to an era of savings, where the savings rate back in the 1980s, as according to this research, of about 10% was viewed as being long-run stable for our growth coming out. So if we were to return back to that savings, that means we're not consuming, because if we have $1 that we earn, you either consume or save it. But for the long-run growth, it takes a while to get there. It creates some short-term pain. So as we work off this debt and return back to savings, this consumption is likely to remain fairly slow coming out. Now, what does this mean for agriculture in particular? Consumption is very important for us too. In particular, looking at the products that we produce to see who is buying it and how much of it are they buying. And in particular, we've seen those food expenditures rise here coming off of the financial crisis. But this elevated unemployment rate presents some significant challenges, and in particular for us in the livestock industry. We can see that food expenditures at grocery stores for at-home consumption and at restaurants for away-from-home consumption fell significantly throughout 2008 and 2009. In fact, dipping into negative territory. But since that time, we've seen the consumer come back, albeit slowly, and today is setting about at 5% year-over-year change on in-home and at-home consumption. But for us going forward, the significant challenge for us to see continued growth in those food sales is an elevated unemployment rate. And in particular, some of the research that I've done to look at, well, what does an elevated unemployment rate, in particular during a recovery, mean for livestock expenditures? Now, if we look back over time at the unemployment rate, when it comes off of a recession, we see it fall. So take the recessions in the 60s, the 70s, and 80s. Following that recession, we saw the unemployment rate fall almost automatically. Now, that is a signal that businesses saw that we were in a recovery mode and began to hire again and pull down that unemployment rate. But an event has occurred in the 90s and 2001 recession, something that's coined a jobless recovery. That is, we're in a mode of recovery in that white area, but that unemployment rate continues to tick up. Employers are taking more of a wait-and-see approach to things, making sure that the economy is indeed recovering and that there is enough demand out there to put these people to work to produce the goods that will be purchased. Now, what that means for the livestock industry is actually we see those livestock expenditures fall during a recession and then continue to fall even during that jobless recovery. As that unemployment rate ticks up, consumers have less money to purchase for some of those higher end cuts. They continue to consume meat, just not those higher value products that are out there. Now, one thing that is pointing to, at least in this part of the jobless recovery, if I flip back and look at, we can see that those restaurant sales, some of those away-from-home products where there's more processing involved, do remain elevated, and we have seen some improvements on that. And you can look at that from some of the demand pulling up these livestock prices today, which has helped in addition to cutting of supply. Now, for the agriculture as well as the U.S. economy, consumption is key, but it really all boils down to when are businesses going to hire? When are we going to see that unemployment rate come down and we enter into a period of recovery? Well, if we look at the market conditions for business and financial market conditions, we can see that there are some improvements. However, there is a great deal of uncertainty that's out there that is weighing on these businesses' decisions. One thing to look at for when might be a triggering point or trigger for businesses start hiring again is to look at where are their investments going. What is their investment dollars? Are they investing in their business? Now, the leading indicator for that tends to be equipment and software investment. The way I like to think about it is I grew up on a farm, and in a pinch, when things were tough and times were tough, you get pretty good at grabbing duct tape, baling wire, holding together that piece of equipment to get you through that tough time. Businesses are no different. Through the recession, you can see that equipment and software spending fell dramatically as businesses put off and delayed purchasing of equipment or updating of software. But today, we began to see an increase in that, and many economists were feeling that as businesses get back to update equipment, to update software, that tends to lead investment in structures. The brick and mortar buildings and factories, things that put people to work, we were beginning to see some improvements in that. And in fact, as any economist would say, we were starting to see less negative numbers in those structures and investments. We started seeing that tick up, but here recently with some of that soft data, some of this is being called into question. We've seen those investments still dip down, but might add those equipment and software expenditures are still positive today, albeit not as robust as they were in the past. Now, turning to financial markets, we've seen a significant amount of improvement in financial markets, especially coming off of the financial crisis. Now, one way to illustrate this improvement is to look at the Federal Reserve Bank of Kansas City's Financial Stress Index. Their financial stress indexes, it looks at many different metrics within financial markets and calculates it into one simple, easy-to-follow index that looks at financial stress relative to the long-run average. So as that index rises above 0, there is more financial stress relative to the long-run average. And if it's below 0, there is less stress than the long-run average. And it's pretty evident that during the financial crisis, we saw that stress rise significantly, as indicated by the stress index, reaching nearly level of 6. But since that time, we've seen that come down. And in fact, it's hovered around its long-run average. Now, more recently, we've seen an uptick in that volatility measure, and a stress index measure, primarily because of a significant amount of volatility that is out there in the marketplace today. But we're still at about that long-run average, and financial markets have improved. So with these improvements in business and financial market conditions, why are we not seeing a great deal of hiring come around? And a lot of that just stems from the significant amount of uncertainty that is out there in the marketplace today. Now, looking at economic theory would tell us that when households or businesses are faced with uncertainty, they take a wait-and-see approach. Let's hold off on making that decision to build that factory. Let's wait and see if this economic recovery will actually take hold. And one way to illustrate this is just to look back in time and to say, well, what happened to that unemployment rate coming off of the 1991 recession? We saw it tick down and come down to an extremely low level of about 4%. And then, in fact, we started to see it come up about to right around a range of 5%, something that's not uncommon to see it bounce around 4 to 5%, especially in a period of robust growth that was going on in the late 90s, early 2000s. And we started to see that professional forecasters were telling us that it was going to hover right around 5%. Now, this occurred in August of 2001. But the tragic events of September 11th, 2001 in New York City changed the landscape, created a significant amount of uncertainty, and we saw businesses take a wait-and-see approach for unemployment rates shooting up. It's not all that uncommon for what has happened today. There's a lot of uncertainty about the consumer, whether or not they will come back. What are the fiscal policies that are going on in Washington, D.C.? Many of the businesses I talk to are still concerned about health care and what that means for that added cost for their business. There's still some uncertainty surrounding that, as well as other things that are going on, from debt discussions, from austerity plans going on even in Greece as around the world. Businesses are faced with a lot of uncertainty and are taking a wait-and-see approach at this time. Now, to combat some of this uncertainty and this very anemic recovery, the Federal Reserve has employed significant monetary policy accommodation. A significant amount of liquidity as well as low interest rates have pumped into the economy, which presents an opportunity for many businesses. Borrowing costs are extremely low today. But the challenge with that, with all this money beginning to be pumped into the economy, is that questions of inflation are beginning to rise. With all of this liquidity that's out there, are we setting ourselves up for potential challenges in the future? Now, one way to look at this low cost of borrowing is just to look at the effective Fed funds rate. Now, this is the rate that the Federal Open Market Committee, the FOMC, they set a target range for their traders in New York City to make trades, to trade the Fed funds rate at a particular bound. And what that is that's the overnight rate that banks loan to each other, and many short-term interest rates are based off of this. And you can see how it has fallen to the zero bound, or basically being traded between 0 and 25 basis points. As a point of reference, typically it sets at about, well, at least heading into before the recession, was right at about 5%. Now, when this was not enough to stimulate a lot of borrowing activity to get things going, the Federal Reserve embarked on something that is called quantitative easing, or just flooding the markets with a significant amount of liquidity. In fact, did 2 rounds of this. The aim of that was to lower longer run or longer term interest rates to try to stimulate and kickstart borrowing. But that has not happened. We've seen a very wait-and-see approach from businesses, but also from the lending side, banks are taking more of a wait-and-see approach too as they try to assess the risk that is out there. To put this into perspective, where that liquidity is setting, a lot of that is setting at the Federal Reserve. And it's being held by banks in the form of excess reserves held at the Fed. Today, that number sets at just under $2 trillion. That is a significant amount of liquidity that banks have available to them to make loans on. It's paying an extremely low interest rate. In fact, it's so low that during more normal times, that number sets well down there right at like $200 billion or so. The reason that it's set so low is a bank's production process is to make loans. They want to get out there, use these funds to put it to work, and make those loans to earn a higher rate of return. But at this time, with this excess reserve setting at $2 trillion, they're in a wait-and-see approach as well. Now, with that significant amount of liquidity that's out there, a lot of people start to ask that question of, well, what about inflation? Well, to frame it, let's take a page out of Econ 101 to look at, well, what about inflation? What's going on with that? By definition, for rapid rise of inflation, we would have too much money chasing too few goods. Certainly that $2 trillion that's setting out there is too much money. There's certainly a lot of liquidity that's out there. We have too few goods as businesses built up inventories but are starting to work them off again. This chasing piece is what we're missing. Velocity is what economists call that. That people are using dollars to go and chase that to see if we can go out and seek other gains that are out there. That chasing piece has been very low, which has helped tame inflation that's out there. If we look at any number of measures of inflation, and 2 I have up here as headline and core inflation, they are extremely low, especially by historical standards. Today, core inflation, which strips out volatile food and energy prices, sets at below 2%. And many within the Federal Reserve have stated that that is an inflation rate that is far too low. Deflation was a concern throughout the financial crisis. It's not as much of a concern right now, but certainly that's something that would create a significant amount of stress and turbulence. But inflation could do just the same thing. To put that in context, think back to the 70s and 80s when we had a very high inflation environment where core inflation was rising to about 10% during that period of time and created a significant amount of stress for businesses as well as consumers as prices were rising very rapidly. Now, today, that doesn't mean that inflation is not apparent within the U.S. If we look at food and energy prices, you can see that it has been quite volatile throughout this period. We've seen increases in gasoline prices, oil prices, paying at the pump, as well at the counter for, especially on meat products. We've seen that increase, and that has hurt the consumer, to hurt the amount that they can consume, which ultimately flows through and affects the economy as a whole. So inflation, especially from an agricultural perspective, can damage a lot of our profitability. So when might that pick up? When might we see that inflation really tick up and start to head on a rapid rise up? And it all goes back to velocity, that chasing piece that is absent for today. To look at a measure of velocity, just to put it in context where we're at, I've calculated a turnover ratio, so to speak, taking GDP divided by the money supply, or M2. What this is taking $1 of that money supply and putting it to work throughout the economy, lending it through to see how we can have that amount of growth. Now, this typically falls during recessions, as you can see in this graph, where it pulls back as lending activity does not occur. But in today's velocity measures, we're essentially setting at periods of 1970. We are extremely low. But at this low cost of borrowing, at some point, businesses are going to come back and be ready to borrow those funds. The question is when. The how, and to point out measures that we can look at and examine to say, well, where might this pick up? And we begin to see it. Velocity is one way. The when is the question. When will that happen? As uncertainties begin to unravel and we have some certain rules and guidance that are out there, we start to see the path of the economic recovery as it begins to take hold will likely be when we would see this velocity kick up and then begin to have to be pulling back a lot of that excess stimulus that's out there. Now, one thing that we learned from how to pull out that stimulus, we were taught by Paul Volcker in the 1980s. One way to do that is to let interest rates rise. So as a business owner and looking out across the landscape, when this begins to happen, fully expect those interest rates to increase in order to pull back and tame that inflation that's going on. Now, with low interest rates, this is a very positive thing for agriculture. Generally, what we see is in low interest rates, it pushes down exchange rates and makes agricultural products more affordable in the global marketplace. And we've seen some significant gains in farm income. But agriculture is a boom and bust industry, and you have to always ask yourself, well, will these profits falter? Net farm income throughout time has been significantly affected by outside factors pulling it up. From wartime effort, building additional agriculture needs for agricultural goods, to an opening of export markets on a new Russian grain deal, to changes in fads and diets that are out there from the Atkins diet, pulling up net farm income, and then most recently, additional sources of demand coming from ethanol, as well as export demand as global economies grow more rapidly. But as you look at this graph, there are certainly ups and downs throughout time. And in fact, here, just in the last decade, we had three consecutive years of getting 20% gains in net farm income, as well as 3 collapses of 20% falls in net farm income. The question is here, coming off of the last 3 years, we've had steady net farm income gains, and today USDA is projecting 2011 net farm income to rise at about 20%. But is that path sustainable? Could those busts occur? What could bring that down? Now, certainly one thing that has helped to pull up these net farm income gains is booming agricultural exports. Certainly part of that is from a lower exchange rate and more valuable, our goods are more affordable in the global marketplace, but also too we've seen a significant amount of income growth outside of the borders of the U.S., which has helped to stimulate further demand. But what are those risks that are out there? And I'm going to touch on just a couple of those to point out some of these risks that are facing global growth. If we look at throughout since 2005, agricultural exports have risen quite significantly. In fact, if we were to look at 2005 and compare to the end of 2010, they've nearly doubled. We've on our upward trajectory in terms of exporting the world, and a lot of that has been led by exports to Asia. Growth in China in particular has been extremely robust, and the U.S. has benefited from that. In fact, livestock exports at the end of 2010 to China alone were in excess of 25% on a year-over-year basis. Significant gains for the livestock industry as well as all of agriculture on exporting those goods. But a lot of that has stemmed from a significant income growth of the Chinese economy. And if we look at this income growth throughout time, it's been exponential. Going back to 1960 and coming through to today, they've been on an extreme upward trajectory. But should we continue to forecast out this exponential growth? Is that path sustainable going forward? What could slow that down and bring that down to where it might flow through and affect us in limiting our exports to China, for example? Well, some of the risks that are out there, in particular with China, focus on two in particular ones. One is an economy that is growing too rapidly and are having a significant amount of inflation. In fact, inflation here currently in China has surged to over 6%. We've seen the Chinese economy come in and say, we need to start cooling it by raising interest rates as well as requiring banks to hold more in reserves as a way to try to temper that economy. Also, we're starting to see some reports of investors as well as economists begin to predict that possibly there's a real estate bubble that is out there. If we were to have a collapse in those real estate markets, we could see significant stress enter into the Chinese economy, which could pull down some of those income growth forecasts and have a negative effect on us here within agriculture. But outside of China, we also have other problems that are out there, in particular the eurozone. A sovereign debt crisis has gripped that part of the world and has most global economies paying attention to it as well. And one way to look at that is to calculate spreads between spreads between 10-year government bonds, the interest rate charged on that, as well as to something that would be considered more risk-free. Take the German Bund, for example. And as you can see, as that spread rises, risk increase, and it's very evident for what is going on in Greece right now. With a significant amount of stress that they are facing from their debt situation that they have, limited tax revenues coming in, we can see that the market is telling us that they are having a significant amount of risk. In fact, if you look on a year-over-year basis, in August, it nearly doubled. And in September, from one of the last estimates that I pulled, it sets at about 25%. Extremely high risk of potentially defaulting on their sovereign debt. Now, to put this in context, to compare to the United States is extremely low. At least at this time, what the market is telling us is that there is a low risk of the U.S. defaulting on their debt. Now, with all of this growth that has gone on, we've also seen a significant change in global food demand. Global food demand is changing out there. As population grows, income growth, people are adding more and more proteins to their diet. But the question is, who will meet this changing food demand? Now, we know that with the income growth, individual households are starting to add more proteins to their diet, but they're also starting to change some of the amenities in which they have within their household. And one way to look at this is to look at those emerging developing countries, the BRIC countries, Brazil, Russia, India, and China, and look at how their households are changing. We've seen an increase in refrigerators that are occurring in their households. So they have more of an opportunity in which to store some protein products from milk, eggs, as well as meats, to keep them chilled within their household. And so we see an opportunity there, but also on microwave ovens, those timely things, the processed foods in order to have that quick consumption. We're beginning to see increases in microwave ovens. Now, they're not at the United States where nearly every household has a microwave oven in their household, but we're seeing an increase in that. And a lot of that goes to those consumer-oriented products that are being purchased. Those household amenities allow these consumers to buy those more processed products. And that's a good thing for agriculture. Those have a lot of value that's added into it. Benefits the entire supply chain and benefits agriculture as well as an economy as a whole. But other countries make note of that too. It's not just the United States who's trying to add value to that. If we look at that growth, that consumer-oriented growth of U.S. exports has been the largest, and we've seen a significant increase in that. But right before the recession, we started to see a significant uptick in those bulk products that were being exported. Coarse grains, for example, that would be out there. And a lot of that came from as other emerging and developing countries begin to develop their own livestock industries, to be able to buy the feed in order to feed their own hogs, for example. One of the individuals I spoke with told me that that's a significant change that might happen within China as they begin to import more grain to feed their own hog industry, to have those consumer-oriented products to meet the tastes and preferences of their own consumer. The question is, who will meet that? Will it be the Chinese economy, or will it be other countries that are out there raising their own products in order to meet the tastes and preferences? Or can it be the United States? The challenge with that is identifying what they want. Bacon preferences, for example, are very different here within the U.S. as compared to China. Identifying those needs and wants will be key for us to continue to have that consumer-oriented products to be able to push out and add value to our own agricultural supply chain. Now, with this growth that has occurred and increase in that, we've had high commodity prices have shot up for an opportunity. Now, here's a classic way an economist puts it. High commodity prices are an opportunity. High commodity prices are also a challenge. The challenge comes in for, especially on those who feed these high commodity prices on the grain side in particular, but also for a global economy that needs to eat as these food prices rise with higher commodity prices. U.S. crop prices have surged. We've seen them actually rise to near 2008 levels. And a lot of that goes to increased growth in terms of demand of purchasing these products, but also a lot of it stems from a severe pullback in the amount of supplies. In fact, for example, on the case of corn stocks-to-use ratio right now in the United States sets at about 5.3%. To put that into context, that's the level it was during 1995 when I know the hog industry faced significant increases in feed costs and saw a huge amount of consolidation during that time. A very tough challenge. And that challenge is certainly being borne out in the livestock industry today. We see break-evens have risen significantly, where profit margins have been very tight. And in fact, if you look through since about 2010, we haven't seen very many opportunities for that. For producers going forward, what this means to me, and when I look at that, is you have to know your margin. Forget focusing on whether or not that livestock price, your output price, is going to rise significantly. You need to know your break-evens. You need to know that price. You need to understand where that margin is. Because to survive in today's climate, that's what it boils down to, is understand your margins that are out there. Also, commodity prices have significant effects on global food prices. If we look at across, world food price indices have reached the near 2008 highs, has created a lot of significant stress, especially on those developing countries. But if we look at the U.S., we haven't seen those significant of gains. And a lot of that goes to because we in the United States consume more processed goods. In fact, the biggest chunk of the U.S. food dollar goes directly to labor. And when we have a limited labor market growth, we have elevated unemployment rates, wages are depressed, we see that those food prices cannot rise robustly. So within the U.S., if we were to begin to see a significant uptick in those food prices, would occur when we start to see that unemployment rate tick down and labor markets begin to improve, and businesses are then able to pass on those higher commodity prices, pass those through to consumers. And finally, what talk about agriculture wouldn't at least touch on farmland values? Probably the one thing that touches on many of us within the room, if we have any connection to ag, farmland values have risen significantly and has been a topic of discussion. For example, are we in a bubble type situation? If we look across various media outlets, from Reuters to the Wall Street Journal, New York Times, and even The Economist, have all brought up this question: have we sown bubbles? Are we going to see a bust in farmland values? Now, to frame this discussion of where we might see these farmland values go in the future, it's helpful to think about, well, how do we value them? Farmers, as well as investors, purchase farmland for its ability to generate future income. The expected farm income that will be received off of that is then capitalized into an interest rate, which bankers call a capitalization rate. So they're taking those future incomes, capitalizing it into value at a given interest rate to arrive at a value of farmland. Now, today's very low interest rate environment has benefits and helps support to boost up these farmland values. And in fact, what we see is that interest rates tend to move with capitalization rates. Think of a capitalization rate as your opportunity cost, or as an opportunity cost. So as these rates have fallen, they have fallen right along with all the other opportunity costs that are out there today. So with lower cap rates in our equation, since it's in the denominator, that helps to push up farmland values or provide upward support to them. But interest rates also have an effect through farm income. As I've talked about before, lower interest rates tend to push down exchange rates, which makes our goods more affordable in the global marketplace, stimulates demand, and helps to pull up our revenues, which lifts net farm income. So with low interest rates, we've seen the numerator in net farm income rise, as well as the capitalization rate fall, all of which has led to a significant increase in farmland values. Now, how might these interest rates change over time? To look at that relationship of it through, we can see that real interest rates tend to move in correspondence with capitalization rates. If we look at Nebraska, calculated a capitalization rate as taking the cash rent to land value ratio, and then put up there a similar interest rate on a longer term, because farmland is a longer term investment, the yield on a 10-year U.S. Treasury rate adjusted for inflation. And as you see, back in the 1970s, when we had extremely low interest rates on a real basis, and in fact dipped into negative territory, we saw that those capitalization rates fell. Now, heading into the high inflationary environment, when interest rates were allowed to rise, we saw that yield on those 10-year treasuries shoot up, which pushed up capitalization rates. And if you remember what happened during the 1980s for farmland, we saw a steep decline in farmland values. Now, since that time, we've seen interest rates trend down as well as capitalization rates. And in fact, today we sat at least on the Nebraska side, capitalization rates at an extremely low value of about 5%. Now, you could do this for other land out there, as well as ranch land and cropland in other states, but you tend to see the same thing pop up. Capitalization rates today are at historical lows. On the farm income side, we can see that in general, when interest rates fall, short-term interest rates fall, we see that net farm income boost up. Now, to give us some idea of how those interest rates rise, what that could mean for net farm income, look back at the 1980s and that period when we saw real interest rates on one-year treasuries shoot up to about 7.5%. We saw steep contractions on the net farm income side. Today, we've seen that bounce around where we've seen that opposite movement of that. And with these low interest rates pushing up, affecting net farm income as well as pushing down capitalization rates, farmland values have surged across the U.S. And in fact, in many states, we've seen over 20% gains according to Federal Reserve surveys from various districts. And this is for, in this case, on non-irrigated cropland values, but we've even seen gains on ranchland values as well. But the question I have is, what happens if we enter back into a more normal interest rate period? We cannot stay at the zero bound forever. That is clearly not sustainable in the long run. At some point, those interest rates will have to come up. And history has told me that, well, when those interest rates rise, capitalization rates rise as well. So if we look at what might happen if we rise to a historically capitalization rate and keep everything else constant, what could happen to farmland values? So what I've done is I've continued the example of Nebraska here, and I followed my formula, made some assumptions on crop prices and the amount that it's being capitalized in, and I can, in today's current market, justify those farmland values. In the case of eastern Nebraska for irrigated cropland, farmland capitalization rates today are about 5%. We have elevated corn prices. In fact, in my assumption, I just used a $5.35 per bushel estimate. And I can get to about a eastern Nebraska irrigated cropland value of about $5,300. Now, that was calculated earlier this year. Things have changed since then, probably have risen somewhat. But the point is, at today's market, I can justify those land sales that are going on. But what happens if I change just one factor? How might this flow through and affect farmland values? Well, if I was to increase that capitalization rate to a more longer run average of 7.5%, with rising interest rates, we could see those farmland values fall by a third. We could see a significant drop in that, would create a fair amount of stress. Now, the good thing is, at least from talking to bankers and looking at the data, we're not near to the amount of leverage that occurred during the 1970s and 1980s. Not as much debt is being provided to finance these farmland purchases. But still, a drop of a third in farmland values would shake a lot of the agricultural industry. But if we were to stay at that 7.5% capitalization rate, what value or what price per bushel would we need in order to maintain current farmland values? And at a 7.5% capitalization rate, we would need $8 corn in order to maintain that $5,300 or $5,300 per acre irrigated farmland value. Now, there are some estimates out there that we might expect to see that come up, but remember, rising interest rates tend to push down farm incomes, which can have a negative effect on corn price. And in fact, if we were to fall down to that 2009 average, if we were to fall back to that 2009 average corn price of $4 per bushel, we could see at a historical cap rate, we could see those farmland values fall by about a half. So, I guess in conclusion, to wrap up, I am cautiously optimistic about the swine outlook. In particular, where a lot of my, looking forward for the swine industry as well as agriculture, we are in a period of recovery. It is bumpy. Many recoveries coming off of recessions, especially as steep as this, are choppy and bumpy coming out. But we are in that. Global growth outside of the U.S. is helping to stimulate a lot of these income gains with a low exchange rate. And with the recent announcement of keeping the federal funds rate at the zero bound until mid-2013, should provide some additional support on that exchange rate side. Diets are changing that are out there, adding more and more protein. There's a significant amount of population growth. And there has been a fair amount of consolidation. So the producers that are there today should be stronger. But the key is to follow those margins. Today's volatile marketplace puts an extra amount of importance on knowing your break-evens and maintaining that margin to be successful going forward in the future.